Welcome. Thank you so much for joining us for our Waddell and Associates 2021 Outlook with David Waddell. Those of you who do not know, David is our Chief Investment Strategist with the firm, also the CEO. We do try to keep him pretty busy in the markets, though. We do want your questions today. Those of you joining us by Zoom, you'll see a Q&A box down below. Type in your questions there, and I'll see those. And hopefully we'll have time at the end to get to everyone's question. However, if we don't, you'll hear from us directly to follow up and answer those. But for now, I invite you to sit back for David Waddell's Economic Deep Dive.
All right, good morning, and thank you everybody for clicking in. Minimize that screen. So this is our 2021 Outlook presentation, the spoils of war. It feels really good to say 2021 after such a challenging 2020. First, want to take a moment to express our condolences to anybody who contracted or certainly fell victim to this awful coronavirus pandemic. We had people within our client family that we lost this year. It's been a very difficult experience. As a human being. It's also been a very difficult experience as a money manager. Now, fortunately, and I say that tongue in cheek, I was sort of born of crisis. I began my career in 1998 during the Russian currency crisis, and then seemed to be in the middle of the dot-com bubble bursting in 2000, followed by the attacks on 9/11 in 2001. And then a little further down the road, we had a great financial crisis. We've had a bunch of flash crashes and all sorts of treasure events that have occurred along the way. And so when the coronavirus hit, I actually knew what I needed to do. Number one, I had to look at history hard and fast to find a proper analog with which to create a framework. And with that framework, I could make strategic decisions for the portfolio. If you don't have a framework, then you can't play offense amidst a crisis. You end up playing defense. And if you don't have a strategy in a crisis, sometimes that can end up killing you, if not obviously doing damage to the portfolio. And so going through the COVID experience caused us to create a framework very quickly. And I'm going to walk you through a couple of frameworks today. But the point of this presentation is to show you that the way to address these pivotal moments in the marketplace is one, to rely on history, figure out the proper analog, create a framework, and use that to inform your strategic decision making. So I'm going to take us back 3 years and walk you through a couple of frameworks that got us to this point. And then I'm going to share with you the historic analog that we've used to construct our framework for this post-COVID period, which we're calling the spoils of war. So with that, let's begin. Here are some disclosures. Enjoy those. For those of you who have an opportunity, come back, revisit them later, help you get to sleep. All right, so 2019, we stood before you, I guess, live, having this conversation that outlined sort of our late cycle battle plan framework for what we saw as the potential end of the economic cycle. And we looked at the end of the economic cycle through the following 4 stages. One, we needed to see rising inflation expectations. That would lead, of course, to central bank contractionary policy. And then we'd end up looking for pre-recessionary indicators. And once those triggered, we would expect the bull market to end, a recession to occur, and then the economic cycle to start all over again. Well, in 2017, we did see rising inflation expectations to a level that exceeded the Fed's comfort zone. 2018, the Fed started raising rates at every meeting and also started tapering their balance sheet, decreasing purchases, sort of a quantitative tightening, if you will. And that led us to identify and broadcast our favorite, I call them my desert island indicators or deserted island indicators. And for that point in time in 2019, our deserted island indicator was the index of leading economic indicators. Now, this is a chart that goes back to 1960. And basically all I'm demonstrating here is that every time this index fell below the 0 line, a recession more often than not would follow. So this was the pre-recession indicator that we were paying the most attention to. And when this is zooming out to the last 20 years, when we got into late 2019, what we saw was this was heading treacherously close to the zero bound. Now, in the past, when we'd had the indicator either fall below zero or approach zero, the government would step up with stimulus in a really big way. So if you go back to the great financial crisis, part of what restarted the economy was massive stimulus on the monetary side. The Fed cut rates down to zero, and they bought $1.3 trillion worth of securities, printed the money, bought the stuff, flooded the market with liquidity. That was QE1. We also had massive stimulus on the fiscal side. President Obama at that point wrote what seems like a small number now, an $800 billion check in the form of the American Recovery and Investment Act. That goosed the leading economic indicators, and we were off to the races until things started to decline again. And the Fed felt like they needed to do more. And so we saw QE2, if you remember, QE3, which was 1.6 trillion, occurred back in 2012, revived the economy once more, only to have things start deteriorating. And then America decided it wanted more economic growth, and it voted for Donald Trump at the polls, who once elected immediately put out a $1.5 trillion tax savings through the Tax Cuts and Job Acts, which was a huge fiscal stimulus package. What we couldn't quite figure out as the leading economic indicators were tapering lower in 2019 was whether the government would do this again, whether we'd see huge monetary stimulus or huge fiscal stimulus in a way that would, again, goose the economy and keep us away from recession. So without clarity on that, we became fearful and talked a lot about it, that we might be on the edge of a recession after 10 years of a very long economic advance. Now, for gray-haired investors like me now, you know that recessions end up being particularly painful for investors. Now, they're infrequent, so this goes back to 1956 and shows you what kind of declines we experienced in the stock market in each one of those recessionary periods. And just to fast track, overall, the average recessionary bear market lost about 37%, and that's something that we would prefer to avoid. Now, the way that we reconstructed our our equity model back in 2018 anticipated the turn in the economy at some point. And so we reserved within our equity model allocation 20% as sort of a risk management tool, right? If we got very excited, we could increase market exposure with that slice. If we got nervous, we could decrease market exposure with that slice by using hedges within the portfolio. And this could end up, because it's a 20% slice, hedge 20%, it ends up being the equivalent of a 40% cash position. So we could take overall net exposure down to 60% if we really got nervous, to avoid that. So we were getting pretty nervous. As we went through 2019, the Fed was, in our judgment, too tight. So we're actually getting contractionary monetary policy. Trump was waging a trade war with China, which was really impacting manufacturing, and it was also impacting trade volumes globally. And so we had tight fiscal policy, tight monetary policy, and then we started to see the markets resemble what we were seeing in the leading economic indicator index with some declines. And so we applied hedges to the portfolio, at the time 10%, so sort of a half hedge position. Now, soon after that, Jerome Powell recognized the folly of his ways, and by the way, was under a lot of pressure from Donald Trump to cut interest rates, if you recall. And the Fed did that. They cut interest rates by 75 basis points, and they also restarted their QE program. The markets looked like they could stabilize, rise higher. And so we took off half of our hedge position. We were concerned that the Fed might be a little too little, a little too late. And so we weren't convinced that that would starve off a recession. And so we still wanted to maybe pump the brakes a little bit in the portfolio to insulate ourselves in case indeed the Fed was doing too little, too late. Well, little did we know that the recession catalyst for 2020 would be this little guy, COVID-19. And when this hit, it meant that we had to immediately build out a new strategic construct, a new framework. And to do that, we were going to have to go back, as we do, and find a proper analog from history. So our pandemic battle plan was crafted using this. The 4 deadly pandemics since 1900, you've heard me say this a bunch, but it matters. This is the framework. We had a deadly one, obviously, in the early 1900s with the Spanish flu. And then in 1957, we had the Asian flu, which was particularly lethal. And then we had the Hong Kong flu in 1968. And then in 2009, we had the swine flu, which was highly contagious, but not that lethal. So we went back and looked at what happened in the economy, what happened in the markets, what did the government do, and what can that tell us about how each of those institutions will respond to COVID-19. Well, just to give you a sense, each of these was lethal, right? And I've adjusted this for population so that it's an apples to apples comparison. But in 1918, we lost 214 million souls on the planet. We lost 2.9 to the Asian flu. I did the math this morning. I think we're at 2.2 globally right now. So right within that range currently. In 1968, the Hong Kong flu claimed 2.2 million lives. And as I said, swine flu, contagious, not as lethal, 411,000 souls sadly lost. What's interesting is that in each one of these periods during the entire infection period, GDP actually rose, right? 10% during Spanish flu, 2.4, Asian flu, Hong Kong flu, 3.2, swine flu, 3.6. Nobody even noticed that one. Although there is a picture, if you Google it, of Obama taking the vaccine. There was a bear market, but the only real bear market that occurred happened within the Asian flu pandemic. And over the entire infection period, the Dow actually rose in 3 out of the 4 pandemics. The Hong Kong flu, the decline in the Dow was more related to what was going on in Vietnam, not really a reaction to the Hong Kong flu. And so quite frankly, this was a bit encouraging. But of the pandemics, the one that struck us as the most proper analog to build a framework was the Asian flu pandemic. So let's look at that a little bit closer. So the Asian flu pandemic really hit in the back half of 1957. And as case counts rose, the market declined just like it did during COVID. And so we actually shed 21% on the Dow between the summer of 1957 into the end of the year. Economically, we saw the biggest quarterly drawdown in GDP since the Great Depression. So in the first quarter of 1958, the economy actually came down 10.4%, which was a lot. Now, at the time, we did have quarantining. We did have social distancing. We did have masking. It was all voluntary, but it did mean that retail sales for the first time, I think in US history, or one of the only quarters in US history, actually declined during that period. So it was a severe recession and people felt it. But then as you can see, there was a great recovery on the other side. Thanks to this man. This is Maurice Hilleman, and he was the one that developed the vaccine that ended up being 50-60% effective against the Asian flu. But because of him, the market regained its confidence. The economy rebounded. By the end of the period, we actually saw record levels in the Dow. We saw record levels in GDP. And so thank you, Maurice. By the way, he figured out the virus from reading a New York Times article about what was happening in Asia and went to drug manufacturers and went around the FDA and said, we need to make a vaccine. And he had 40 million doses out there in the marketplace by the end of 1957, probably saved 1 million lives or so. So thank you, Maurice. All right. So by the end of that period, the Dow Jones actually had a total return of 6%. So now let's apply what we've learned from that historic analog. All right. First of all, there was a stock market crash, as you know. What we saw was fear hit historic levels, right? We had a bullish sort of thesis, but we were waiting for a moment to act on that. And the opportunity came to us as fear exceeded in the markets what we saw during the great financial crisis. Markets actually declined 38% during a 30-day period. It was the fastest drawdown in markets in history. And to us, created an opportunity, but we needed a catalyst to realize that opportunity, or at least to initiate it. And so the catalyst was this man. I love this photo. In fact, I may get this framed and put on my office wall. This is Jerome Powell on March 15th, he came out and said, look, I'll do whatever it takes. We'll cut interest rates to zero. We'll restart quantitative easing, and we'll do it at an infinite degree as quickly as we can, as you see on the chart on the right-hand side. And that did end up sparking the turn in the markets, but it didn't really totally address the economic decline. In the second quarter of 2020, the market, or the economy, excuse me, did recess severely. In fact, it was the largest quarterly economic decline in US history, down 31%. Now that's a quarterly basis. It's a $20 trillion economy, so that drawdown translates into a $2 trillion loss overall. So we had a record economic decline that we still had to deal with. We had a 2 trillion GDP drawdown. The Fed did its part. They came out with their 3 trillion in quantitative easing. They did 4 trillion in loan guarantees, but Congress needed to step up, and they did in a big way with record fiscal stimulus in record time, 3 trillion overall in the first basket, to give us basically 10 trillion in stimulus to address a $2 trillion problem. So with the Fed and the congressional leaders all in, it appeared to us, using that Asian flu pandemic as a historical analog, that it was time to get more aggressive in the portfolio. And so we removed our remaining hedges towards the end of March, the first week of April, expecting that we would see a dramatic recovery in the markets, which we did, and also a dramatic recovery in the economy, which we did. So in the third quarter of 2020, the US economy grew at a 33% pace, quarter over quarter annualized, which is a absolutely historic rate of growth for the US economy. And what's even more astounding is that you may have noticed that housing values seem high. It's hard to find a boat or a bicycle, et cetera. That's because household net worth, turbocharged by direct payments from the government and extended unemployment benefits, the rise in stock prices, actually went to an all-time high in the third quarter of 2020. So here's the bottom line for that COVID epidemic, which we're still in, but at least for this first phase of it. So the COVID outbreak triggered the fastest stock market sell-off in history, with the Dow declining 38%. The worst quarterly GDP drop in history, with a 33% decline in the second quarter, which prompted unprecedented monetary stimulus to the tune of, call it 7 trillion and rising, and record fiscal stimulus to the tune of 3 trillion and rising, which led to record-breaking recovery pace for the stock market, now up 68%. I did this a few days ago. As of today, we're at all-time highs again, which is great because you need to be validated by the markets when you're giving a presentation you worked this hard on. So at least for today, all of this appears true. The highest recorded GDP growth in Q3 at 33%, and the highest recorded household net worth at 119 trillion. So as we do our personal audit and we go back and we look at the analog, the construct, and the investment strategy from our pandemic battle plan, I have to say, at least financially, for the clients of WNA, we can declare victory. But that's the past, and we get paid to predict the future. So where are we going from here? For this, we have to now build another construct, find another historic analog, and come up with strategy. So now let's talk about my 2021 post-pandemic battle plan. First of all, COVID is and remains a global catastrophe. And the last time we saw a global catastrophe anywhere near this scale was in World War II. This is a picture taken theoretically, supposedly, on September 1st of 1939. It's the Germans invading Poland, setting off 6 years of a global catastrophe that ended up claiming 20 million lives. Now, I spent a lot of time digging through this, again, from a market perspective, an economic perspective, and a government perspective. And what I found was really useful. There are 4 distinct stages to the market and to the activities in and around World War II that can help inform the framework for us going forward. First of all, first stage, denial and fear, okay? So Hitler invades Poland in September of 1939. The word in the US was, that's interesting, but doesn't involve us. What it does mean is that Europe's going to need to buy a whole lot of stuff, industrial goods. We have lots of factories. So overall, this could be very good for the US economy. And so actually the United States stock market during the denial phase rose in reaction to Hitler invading Poland. Then when the German blitzkrieg started to concern markets that maybe he'd be successful in conquering Europe, the markets went down a bunch. They rallied back because, again, we were neutral. And then by December 7th in 1941, the Japanese attacked our fleet at Pearl Harbor, and suddenly we appeared vulnerable and were now involved in World War II. So during the denial and the fear stage of this analog, the markets actually fell 40%, and rightfully so. And then something changed, right? You got to have a vaccine. Well, this was perhaps the vaccine, at least for the markets. This is quite a story. Many of you are better World War II historians than I am, but this is a meaningful piece of history here. This is Torpedo Squadron 8. On the morning of June 6, 1942, 30 of these soldiers woke up, these airmen, took to the skies, flew antiquated torpedo bombers right into the belly of the Japanese fleet. They attracted all of the attention from the far superior Zeros, all of the attention from the artillery for all of the aircraft carriers and everything that were in the Imperial fleet. And every single one of them died, save one. So it was 30 soldiers overall who took to the skies. One survived. He bobbed in the ocean for 2 days. All 15 aircraft were lost, but they distracted the full force of that fleet while our dive bombers were able to peek out through the clouds and take out, I think we took out 4 aircraft carriers during the day. It was a massive victory. And again, this was the Battle of Midway. Now, many will tell you that the victory that was enabled by this torpedo squadron turned the tide in the war in the Pacific. I'm not here to argue that. This I do know, it turned the tide for the markets. And that's how we entered stage 2. Suddenly we started having a little confidence. Maybe the US had resolve. Maybe the US would turn its industrial powers towards the war effort. And if that's the case, maybe they could win the Pacific. And so markets started recovering as confidence in the US's success started to build. So as we moved through the next 12 months or so, we also had a moment where the Germans had to surrender in Stalingrad after getting bogged down, obviously, trying to capture Russia. And that made them look vulnerable on the Eastern European war front. Further along, we had D-Day, obviously, that made the Germans look vulnerable on the Western European front. And then finally, going into 1945, we had VJ Day, and finally the Axis powers surrendered. And so the markets rose over this stage too, which is a reinflation of confidence and ultimately a celebration of victory, 107% in the Dow Jones on a price basis. I'm not including dividends, so it's not total return, it's just price. And that was 2 years of advances prior to the actual victory, telling for where we are now. Stage 3, doubt and reintegration. Now, after the war ended, there were 20 million Americans that were basically either wearing uniforms or supporting those in uniform, and economists were very concerned about how they would be reintegrated into the American economy. The thought was that the US unemployment rate would go through the roof, and there was actually a bill that originated in Congress, I believe, called the Full Employment Act, where the government was just going to guarantee jobs to everybody who came back from afar. That would have been very interesting. Now, the Republicans in Congress ended up blocking that bill. And so instead of it being the Full Employment Act, it became the Employment Act. This is important because it's a tenor of a theory we're going to talk about a little bit later in the presentation. But the government didn't guarantee full employment. What they committed to was to support the pursuit of full employment. That was a very involved way for the government to be in the economy, more so perhaps than they'd committed to, at least by statute in the past. But as the war machine cranked down and fiscal spending started to retreat, we did see an austerity recession. And so the market sort of went sideways for this 2-year period between 45 and 47. Overall, only lost 7%. Unemployment ticked up a little, not nearly as much as the economists thought. The American economy is always much more dynamic than people give it credit for. So in the doubt and reintegration phase, basically we emerged unscathed with a 7% loss overall in the Dow Jones Industrial Average. Now we get to the spoils of war, which is stage 4 from what I put together after looking at the entire World War II experience. And over the period from 12/31/1947 to 12/31/1959, the markets basically went 250% higher in price terms without interruption. And by the way, that interruption was the Asian flu, which you can see there on the chart. So why did this end up being such a prosperous period post-war? Well, there was a shift in the way the government was sort of relating itself to the economy. We'd come out of the Depression. It was very government-centric. Truman had to work with the Republicans in the Congress and basically said, all right, here's the thing. We're going to do everything we can do to enable the growth of the private sector. So growth, development, efficiency, and productivity became the mission statement for the government in terms of economic management. And they ran, pretty much balanced budgets to burn down some of that debt overhang. There were tax and tariff cuts to make, the system more efficient. And there was very low inflation for that entire period. And thanks to all the carpe diem for the sailors coming home, there was a huge lifestyle shift in the country. This was our first real consumer generation. There was lots of pent-up savings after all the rationing. The credit card, which was Diners Club, was actually invented, I think, in 1950. Clearly, the soldiers wanted wives, they wanted kids, they wanted cars, they wanted houses. And so we had this whole suburbanization of America. And we also had some great innovations. We had the first computer, the first microchip. Oil was pretty cheap. We had passenger jets. And then in 1956, I think, Eisenhower signed the Interstate Highway Bill. And suddenly the entire country was networked. Everybody got a car. And so it was an enormously prosperous period. Productivity rose at a high rate. Wages rose at a rate that was basically commensurate. And we had above average GDP growth. And ultimately over that period, corporate profits went up 4x. And the multiple on the market went up 2x. So it was just a tremendously positive period post World War II. So here's the full World War II story with numbers to help inform our strategy going forward. The first stage in the World War II story was, again, denial and fear. Because we were running the war machine, we did see GDP growth that was very high. There was an inflation rate of 3.3%, which was basically in line, but it was hard on investors during that period. As we showed you, as confidence was declining in our abilities to win the war in the Pacific, and certainly concerned about what Hitler was doing in Europe. And then we got into the phase post-Torpedo Squadron 8 of confidence and victory. GDP, we were still running a war machine, grew at 11% annualized. There was inflation because of scarcities within the economy, but the total return for large stocks, 150%. Look at this number. God, I wish I could go back in time and play this game. Total return for small cap stocks over that period of time was 626%. Small companies were left for dead in the eyes of investors. Remember that. Doubt and reintegration stage 3. Again, the economy was trying to figure out how to pull 20 million people back in, retool them, deploy them in useful ways, which it did, but GDP growth did suffer as fiscal spending came down. The inflation rate went higher as the government removed their price controls, and it was a crummy time for large stocks and small stocks, but not terrible overall, especially knowing that right around the corner in phase 4, we had the spoils of war. GDP was at an above average rate of growth, as I just described. We also had this lovely low inflation rate for this entire period. Small cap stocks went up 440%. Large cap stocks went up 638%. It really was a golden age. So now let's use this historic analog to see if we can build a framework going forward, applying what we've learned, obviously, to the coronavirus affair. So here's the COVID story to date. In my judgment, we went through stage 1, which was denial and fear. That ended March 23rd when the market bottomed. But remember, COVID really showed up in January, and we ticked higher into February, and then finally the world collapsed. So a very condensed version of what we saw in World War II, but still, directionally very, very similar. So we had denial and fear. GDP, because of what happened in the first quarter, specifically March, fell 1.3% during that period. Inflation declined. Large stocks, as you know, went down 35% overall categorically. Small stocks did worse, down 41%. And then once we got help from the Fed, help from the central government, and everybody believed the scientists would come through at some point, we were able to enter stage 2, which is confidence and victory. I'll update these numbers. Obviously, the drawdown in Q2 was severe. Q3, Q4, GDP just came out. So during this period, the economy detracted 1.2% from GDP. Inflation was level, is still level at 1.5%. But just as in World War II's stage 2, small caps dramatically outperformed large caps in stage 2, where we have an overweight and certainly used the WW2 experience as our analog for our framework and our strategy. It was very helpful. What about stage 3 for the COVID affair? Not going to happen. We do still have 10 million people in the United States who are unemployed or loosely employed. The reintegration of those people can be rather fast. We just have to reopen the restaurants. We have to reopen the retailers. We have to reopen the cruise ships and the theme parks. They'll flood back to work. So I don't think we'll go through this transitionary period of indigestion, if you will. I think once the COVID vaccine is declared squelched, people will go right back to work just as they did before. And so let's talk a little bit about COVID stage 4, because I do believe now is the time for the spoils of war. First of all, the government hasn't really turned off the war machine yet, right? So our effective federal funds rate is still pegged at 0. So we have 0 interest rates. And the Fed is continuing to print money somewhere between 70 billion and 140 billion a month. And so there's still a lot of quantitative easing going into the system. And in June, Chairman Powell said, we're not thinking about raising rates. We're not even thinking about raising rates. And so the Fed is completely and totally committed to leaving the war machine on. Now, this is creating an absolute gusher of money supply. We've never seen money supply growth like this in the United States history, up 27% year over year and continuing to rise. And so the war machine monetary policy is continuing to operate. What about the fiscal war machine from Congress? Well, that's continuing to operate as well. This is a chart that shows you total federal spending as a percentage of GDP going back to 1900. Now, obviously, when you run the war machines in World War I and World War II, you're going to spend more money, and they did. So in World War I, we spent 25% of GDP through the government coffers. World War II, the government spent 45% of GDP, and then you can see why we had that austerity recession I talked about earlier in stage 3. But look at COVID, right? So COVID was 35% of GDP, and they're not done yet. So here's the additional spending on tap. At the end of the year, the government passed a $935 billion relief bill that was incorporated at the end of Trump's term. Now, Biden is activating reconciliation to see another $1.9 trillion in relief injected into the economy. And I went back and reviewed the Biden plan to save America from the campaign trail. And, you know, whether you could take these things at face value or not doesn't really matter. Directionally is what matters. But in that plan, he called for another 1.9 trillion to be spent on education, 1.6 trillion to be spent on infrastructure. Everybody expects that's where he goes next. We'll find out in the State of the Union, I suppose. 1.6 trillion more on healthcare. Now there's some deductions based upon savings and prescription drug benefits, et cetera. Whether that happens or not, I don't know. So I'm using the gross figure of 1.6 trillion. 650 billion in housing in the funnel, and also 290 billion in Social Security. So if you add all that up, assuming you could pass it all, but again, it's the direction that matters. If you add that all up, it's $8.8 trillion, which is about 45% of US GDP, over and above the 20% of GDP that we spend just on average, which would get you to 65% government spending as a percentage of GDP. That's historic. And so this needs to be understood. This is the most important concept in this presentation. There is a new fiscal operating manual in Washington, D.C., and it's called Modern Monetary Theory. And I'm going to try and explain it here now. All right. First of all, go back to your kitchen table household finance logic, and let's think about where funding comes from for the government. right? Where does the money come from? Well, in the traditional logic, it comes from the taxpayer. And so we, as taxpayers, fund the government through taxes and lending them money through the treasury market. So just to make that simpler, private sector, this example, pays $90 in tax, lends $10 to the government. The government then spends $100 on the private sector. And when you look at the books, we end up having in the private sector an asset, which is $10 in government bonds. They have a liability, which is $10 in government bonds. And the government is a currency user because they're acquiring that currency through taxes and debt from the private sector. Now, as the government grows, it limits the economic capabilities of the country because it crowds out the private sector, right? Bigger government spending more money, taxing more money to service more debt just takes more money out of useful operation within the private sector. So deficits in household logic will limit the economic capabilities of the country. Now, modern monetary theory flips that on its head and says the government doesn't need to come to you for taxes, doesn't need to come to you to borrow money. The government can just print all the money it wants to print, which is true. And so in modern monetary theory terms, the government is an issuer of currency, not just a user of currency. In fact, in the example, the government just decides we're going to spend $100 on stuff. And so they print $100, they go spend it in the private sector. And then the government decides basically to achieve social objectives, what kind of taxes it wants to charge and to whom. And so in this example, they decide we're going to tax $90 of that back, which leaves a $10 surplus in the private sector. The government then makes a decision whether to leave that surplus in cash in the private sector or absorb that surplus with treasury bonds. By mandate, they have to absorb that with treasury bonds, but structurally, they don't really need to. It could just sit in cash. And so you get to the same outcome, a $10 surplus in the private sector, a $10 deficit in the government sector. You just get there a different way. And the big difference is the government as a currency issuer rather than a currency user. All right, if deficits don't matter, then what is it that limits the capabilities of the government? Why not just spend all the money and just eliminate taxes and all that kind of stuff? Well, there is a limiter in modern monetary theory. Once the government spending absorbs all the excess unused resources within the economy, think full employment, et cetera, then you're going to stoke inflation. Inflation is a problem. It's a cancer within an economy. So if you hit the inflation rate, then you need to raise taxes or spend less, do something different. But by moral obligation, the government needs to spend the money to provide the economic resources to get us up to that point of inflation. So this is modern monetary theory. This is the most important book that you can read this year. It's called The Deficit Myth. It's written by Stephanie Kelton. She was the chief Democratic economic strategist, I guess, within the Senate, key campaign advisor to Bernie Sanders and Elizabeth Warren. AOC relied heavily on her for the Green New Deal. This is the new operating manual for Washington, D.C. And they do have a point, okay? If deficits don't matter, then they shouldn't generate any inflation. And in fact, they haven't. So here's a chart showing the US federal government deficit going back to 2008. Obviously, we blew through the deficit in 2020 at 3.3 trillion. And then here is inflation over that time period. Now, remember, the Fed has a 2% objective, and yet very seldom have we actually risen above the 2% objective. And there seems to be zero correlation between the deficit and what's going on with actual inflation. Providing political cover for our elected officials, the percentage of Americans who say that the federal budget deficit is a very big problem continues to decline. So less than half of Americans worry about the federal deficit at all at this point, which gives them political cover to create more deficits. And they also have a point, overall debt burdens aren't really leading to higher interest rates. So modern monetary theory has been in place in Japan for the last 30 years, more or less. And in the chart I'm showing you on the left-hand side of your screen, the red line is Japan. They, in 1990, boosted their government debt as a percentage of GDP from 50% to up to 250, right? So 4x, 5x, whatever that is. The US, we doubled it from 50 to 100 And when you look at the impact on long-term investment rates, the long-term investment rates in Japan are lower than they are in the United States of America. And clearly, I mean, the relationship almost looks inverse if you look at this chart, right? The more debt that the governments issue, the lower the long-term interest rate. And so overall debt burdens really aren't burdening rates to give them even more encouragement to practice MMT. So now we're at a point where the government has just become this cornucopia of resources. The war may end, but the war machine may still spin. Question is where all of this money is going. Well, it's going everywhere. So here's a chart of the household saving levels during the basically the COVID affair. Consumer balance sheets are completely flush. So there's excess savings on consumer balance sheets right now of 1.4 trillion over and above what they would normally save. And this is despite, dramatic unemployment, 10 million people on the sidelines. And corporate balance sheets are also exhibiting the same phenomenon. This is the corporate saving levels within the S&P 500. There's an additional $500 billion of cash on the balance sheets, despite the fact that earnings will decline 10% overall in 2020. So there is cash everywhere at this point. And this is all leading to the fastest GDP growth that we've seen as a country, probably going back to 1984, best year ever, by the way. GDP growth next year will likely be somewhere around 6%, or this year, I should say. And then the following year, around 4%. Contrast that with the average rate of GDP growth we had during the recovery period after the great financial crisis at about 2.1%. So absolutely unprecedented GDP growth, not too dissimilar to what we saw in the Asian flu pandemic, which, by the way, had no government stimulus. All right, so here's my bottom line on the spoils of war. If you think about the growth in GDP, if you think about all that government spending, all of that monetary stimulus, factoring into higher growth rates for GDP, that by nature translates into higher growth rates for corporate earnings. So analysts right now are expecting that over the next year, corporate earnings will grow, call it 20 to 25%. And that's great news. But the big news is when they look out over the next 5 years, they're also projecting earnings growth of 20% annualized, which is as high as it's been over the course of this survey, for sure. So analysts are super bullish on the amount of earnings that will be generated during this period. And so just to complete the analog, the operating model for the government now is we're going to build a bigger, better, more inclusive American economy. So a lot of social engineering, but a bigger economy overall. And the government sector will work in concert with the private sector to maximize the capabilities of the economy. Full MMT adoption, we won't get there, would include a federal jobs guarantee, much like the Full Employment Act that they contemplated back in the 40s. The Green New Deal seemed ludicrous. When you look at the numbers now, it doesn't seem as ludicrous. We talk about $1 trillion, $2 trillion, and everybody's desensitized. Obviously there's talk about universal health care, loan-free education. I'm not saying these things can happen, but there are areas of the economy where they could spend money. And if there is no inflation, should they, right? Maybe they should. And tax policy really just becomes social policy. And I think recessions at this point have been completely outlawed. Anytime the citizens are in financial or economic pain, the government will come to the rescue. There is a new lifestyle shift in the virtual generation. We're part of it right now. Certainly there's pent-up savings. Those will be deployed. There's this re-ruralization. We got urbanized. Now we're re-ruralizing, which is good for Tennessee. It's the golden age here. And in terms of digitization, obviously we're doing digital offices and schools and gyms and doctors' visits. And there's a lot of technology on the way. Remote work environments like this, 5G wireless. I don't even know what it is, but it means that your phone will talk to your refrigerator, which will talk to your dryer, and all of that somehow makes life better. I think what's most amazing is maybe the combination of artificial intelligence and dexterous robotics will create sort of virtual workers, which is great. That's how we solve our demographic issues. Nonetheless, all of this will occur at some degree, and it'll boost corporate profits by how much? I don't know. It was 4x during the 50s. What could it be this go round? All right. So now we have an analog. We have a strategic framework. The question is, how are we going to invest the money? Well, for that, there are three things we're going to focus on. Number one, we are going to ride this recovery. So the amount of creative destruction that occurred thanks to COVID or not thanks to COVID is fueling a huge boom in innovation. It's sort of like the Y2K phenomenon. So tech and non-tech CapEx are set to soar. The percentage, gains in software and industrial equipment are going to be extremely high. So there's an upgrade cycle happening across the entire economy. And there's also a huge entrepreneurial cycle happening across the economy right now. In fact, a few months back, the number of new business applications year over year rose by 80%, which was a historic level. It's tapered down some, but still 25%, well above what it normally is. And so the combination of the huge tech upgrade and the infusion of all this entrepreneurial energy, which, by the way, doesn't rely on legacy systems, is going to create a surge in productivity, in my opinion. And that means profit margins for existing companies are set to rise. Now, Teresa said there were a few hundred people on this call. We used to serve shrimp and wine, et cetera. We can't do that anymore, but it has created a whole lot more profitability. So the profit margins are benefiting. That's happening, people not using the office space, not using the airplanes, et cetera. So profit margins peaked back in 2018. I think that they'll get back to peak levels again. We're only 2% off those peak levels right now. And as profit margins expand, thanks to efficiencies and productivity, earnings are going to go through the roof. And so projections for next year are at least to have $200 in earnings across the S&P 500. Recognize that in 2019, pre-COVID, we were at about 160. So that's a 25% gain in earnings since 2019, even incorporating what happened during the COVID affair. So earnings are headed, I believe, to all-time highs. So we need to ride that recovery. So that's why we're bullish. But you don't have to chase the momentum names here. Obviously, there's been a lot of talk about GameStop and all that stuff. We don't traffic in that stuff. But there has been a whole lot of money that has flown into large cap US technology names, the FANG stocks. And what you can see here is a chart going back to 1996 that shows you above the line when growth is outperforming and below the line when value is outperforming. And as you can see, between 2000 and 2006, value outperformed for basically a 6 to a 7 year period after being so forgotten. Remember, Warren Buffett was basically, I think, ridiculed on the cover of Newsweek as being out of business because he didn't participate in the tech affair. And yet, as soon as the tech stocks blew up, he became a hero again, made tons of money. So I believe we will see a reprisal of what occurred between 2000 and 2006. And just to add further confidence to that call, this is basically a chart that shows you the relative value between the value stocks and the growth stocks. Think Facebook, Apple, Netflix, Google, all that stuff. Value stocks are at the lowest valuation relatively to growth stocks that they've been since 1999. So even though there are many people who will tell you this market is wildly overvalued, not every part of the market is wildly undervalued. In fact, value is trading at a historic discount to those growth names. And we think within the value investment style, small cap value will actually party the hardest. Unbelievably, over the past 4 years, call it, small cap stocks declined 9%, while large cap growth techie names went up 120%. That's 127% spread advantage to large cap stocks. Now, if you're a contrarian or you believe in reversion to the mean, which I do, this looks like a great opportunity. And in fact, we tilted into it, which was a good thing. Because if you look just at the fourth quarter of 2020, right, economy's going to rebound, small cap stocks that have been left for dead, go back to the WW2 analogy, suddenly get a bid from investors. Small cap value rose 33% in the fourth quarter versus large cap growth, which was up 11%. So this turn is overdue. In our opinion, it is happening. We're going to exploit it. All right. I think you got to favor weak dollar winners in here. I don't want to get too wonky, but basically the U.S. runs two deficits that matter. One is trade deficits. Structurally, we're just going to run those. It doesn't matter what you do with tariffs and how mad you get at China. We're going to run trade deficits. Number two, we're going to run bigger fiscal deficits, right? We're normally running a 3% fiscal deficit. We ran 15% this year. Based upon the spending stuff, it could be 15% or larger this year. So fiscal deficits plus trade deficits are known as twin deficits. And when you have rising twin deficits, you tend to have a falling US dollar with about a 2-year lag. So we would expect the US dollar to be in a cycle of declines after peaking out kind of in the middle of the COVID crisis. It's fallen 10% since then. In environments where you see the US dollar weak, there are places to make outsized gains. Now, in this chart, look at the left side. The gross return for the S&P when the dollar up versus when the dollar's down is basically the same. Investment grade bonds is basically the same. But look what happens when you get offshore. So the EFI index is the developed ex-US index. When the dollar's up, the EFI does terrible, which is basically what's been happening. But when the dollar's down, it's up 20% versus 13 for the S&P. Well, in the emerging markets, when the dollar is up, they really suffer, as you can see. But when the dollar is down, that 35% rate of return is almost 3x what you get in the United States of America. So our call for a weaker dollar has also pushed us further offshore, which is working. Now, here's the spoiler alert. Somebody's going to ask this, so I'm going to go ahead and diffuse it. Right now, the market, by every single metric other than one, is at a historic high valuation. That one metric is the difference between the earnings yield on the S&P 500 and the prevailing interest rate, which is the 10-year Treasury bond. If you look at that spread, stocks are 80% cheaper than bonds. But if something changes with interest rates, then all of these other valuation metrics are going to suddenly matter and start biting. Well, the reason why interest rates are so low is because the inflation rate has been so low. So this chart goes back 30 years and looks at the Fed's favorite inflation measure. And right now we're at about 1.5%. Now the Fed has basically said they're not going to raise rates until we get well above their 2% inflation target. So to me, that used to be a ceiling. Now that's a floor. So let's say 2.5% is really their target before they start raising rates. Should we get a spike in inflation that gets anywhere close to that target, the markets are going to get nervous, rates may rise, and you could see a drawdown in multiples even while earnings are rising, which makes things challenging for investors. So this, in my framework, is now my new deserted island indicator. As long as that inflation rate stays down below that Fed target level, you're going to see the war machine in the monetary side and the war machine in the fiscal side continue to run, and the markets will be sort of undeterred in their climb further into record territory. All right, so here's my bottom line. In 2021, I believe that equities will climb higher. I think small caps will end up outperforming large caps for the reasons described. In terms of style, values just do. And we've already started to see that turn, so we expect value will continue to outperform. US dollar goes lower on the back of those twin deficits. In terms of domicile, we prefer the emerging markets in a weak dollar environment, and so we expect them to outperform. In terms of US interest rates, I imagine they go higher. I mean, they already are sort of on the long end of the curve. Remember, the Fed controls the short end of the curve, the overnight rate. The marketplace controls the long end of the curve. And if the marketplace thinks there's going to be a bunch of growth, those interest rates will go higher, and they're going higher. I think we're at 1.16 today on the 10-year. In terms of bonds, in a rising rate environment, it's hard to make money in bonds, especially if they're interest rate sensitive, because as rates go up, prices go down. So that would be bad for treasury bonds and high grade munis, et cetera, or GSE bonds, but good perhaps for corporate bonds as the economy lifts the financial capabilities of corporations. So credit ends up outperforming interest rate sensitive bonds. And I'm going to give you two threats this year. My first threat is inflation. If we end up getting a rate of inflation that comes anywhere near that Fed target line around 2.5%, it's going to freak out the market. Now, midway through this year, we're going to have to deal with comparisons to Q2 last year. And so we could get a hot inflation number. I'm sort of anticipating that. It'll be interesting to see how the market reacts to that. But then I think you'll end up seeing inflation tapering back down. So we'll be paying a whole lot of attention to that. Now, this is extremely important. The secondary threat, there's a lot of animosity in the country towards because of the large disparity in wealth, those that have from those that don't have. And so while my ego would like to tell you that over the next 5 years, I'm the most important person at Waddell Associates, I don't think that's actually true. It may be Perry Green, it may be Sean Gould, it may be Tim Ellis. It's going to be the CPAs, right? Because it's great if we can generate for you outside investment returns, but if the government taxes it all away, it doesn't matter. So what we're really going to have to pay attention to over the next 5 years is after-tax investment returns. And so you may see some innovative strategies coming from us this year. Heck, maybe Perry will give this presentation next year. That'd be great. So overall, my assessment is this: the combination of continued government stimulus with a significant upgrade in the economy through the innovation cycle, with the pent-up demand and the carpe diem that'll definitely hit the marketplace once we get on the other side of the COVID affair, will lead to record GDP growth, it'll lead to record profits, and it will lead to higher markets. So very bullish on what we can see in 2021 and forward. And so I will be joining you in enjoying the spoils of war. And with that, if there are questions, Teresa, I'm happy to take them.
Of course there are. First, there's a comment from Perry Green, who's out there watching, and he says, "No pressure, David. Thanks so much." All right. Moving on, we have another one. How much of that economic growth was simply flooding the market with government money versus actual business increase?
It's the same thing, right? Because the government spends it on the business. So consider, these numbers are going to get astounding. The economy is 20 trillion, right? 3 trillion of the fiscal stuff has already happened. They're going to pass another 2, plus they got another 935 billion or whatever at the end of last year. So that's $6 trillion. So the government is basically printing, using monetary theory, $6 trillion and then handing it to the private sector. That's 30% of GDP. And that's all going into the private sector. So how much of the economic growth is the government? Lots of it. What would the economic growth be without them? I don't know. But if you go back to the historic analogs, looking at the Asian flu, et cetera, in those periods, the government suggested that you wear a mask. They suggested that you social distance, but they didn't require it. So they didn't have to compensate the economy for forcing it to shut down, forcing it into recession back then. But you saw very healthy GDP growth coming out the other side. People happy to be alive and go out and spend. So I think there is plenty of animal spirits growth stimulating this economy. But I also recognize that in a $20 trillion economy, if the government prints and spends $6 trillion, that's going to lead a lot to economic growth. And we're going to capitalize on it because ultimately it does get spent in the private sector.
All right. And do you see business travel returning to 2019 levels? And assuming not, what are the biggest positive and negative externalities?
I don't see business travel returning to the degree that it used to occur. I would get on the plane periodically and fly to Texas for lunch and fly back. Texas is lovely, and I eat lunch every day. But I don't think I need to do that. I think we can do that over Zoom. So that's a huge margin booster and productivity enhancer. I think, in-person stuff matters, and in our business, it matters a lot. But the more comfortable and the longer this goes on, people get with the Zooms, et cetera, the less of that there's going to be. So I don't think there'll be as much business travel, but whether that's temporary or permanent will be something that remains to be seen.
And what do you think has been the greatest innovation of this period?
I'll go back to Maurice, who had that vaccine developed and out in the marketplace, avoiding the regulators. I'm not a virologist, and so I don't know what the positive, tail effects of that vaccine development really were. But this mRNA sequencing, this 98% effective vaccine that we developed in 9 months or something like that, is absolutely astounding. So the applications for the tech upgrade that we got in healthcare going forward are really going to be amazing. So I think the greatest innovation of the whole affair is COVID. And so there's balance in the universe. And so COVID took away, but COVID gave us some things too. And so lives may be extended, lives may be saved because of the technology that we developed in response to the threat of the COVID pandemic. So I think the best innovation of this time period is clearly what we did on the vaccination side, and the applications to that are, I mean, we hadn't even scratched the surface yet.
All right. And one last question. When will the US dollar no longer be the world's reserve currency?
Yeah. So if we get back into a down cycle in the dollar, which I think we'll get into, there'll be a lot of that kind of talk. I do think ultimately, as the world develops and the spread between our prosperity and others diminishes, and it should, right? More prosperity for them as suppliers to them means more prosperity for us. So as that spread declines, then the hegemony of the US dollar probably declines a little bit with it. But if you're not going to be in dollars, you got to decide what else you're going to be in. Do you want to be in the euros? They have a pretty imperfect fiscal union. They had some problems with Greece back in the day. Do you want to be in the yen? It's hard to kind of get it. It's not a deep enough marketplace, really. You want to be in the Chinese yuan. The Chinese, as a communist party, can every once in a while just confiscate your money if they want to. So the dollar is sort of the last resort currency, I think, at the moment. Although it may share, some love with some other currencies as those economies develop and open up a little bit more. But I don't think there's going to be a demise in the US dollar from a trading perspective. Most trades are settled in US dollars. It really is the world's currency. And so if there's going to be any loss of ground in reserve status, it's going to take decades and decades to get there. We just have the deepest markets. We're a significant portion of global transaction volume. And if you don't go dollars, you got to go somewhere else. And the Bitcoin market just ain't big enough.
All right. And for those of you that sparked questions and you sent them after I said last question, we will reach out and, and talk to you one-on-one. I thank you so much, David, for putting together this wonderful content. Thank you to each of you for joining us for this deep dive. We're over our hour mark, so I do want to be respectful to everyone's time. Please reach out to us one-on-one through the email that you received to Zoom with us today, or visit our website, wealthstrategist.com. Thank you again, David. This was fabulous. Have a great weekend, everyone.
Wonderful to be with you all. Thank you very much. It's an absolute honor to be your wealth strategist, and we appreciate y'all being part of the family. So stay safe, and thank you.